All right, so now we're going to look at the contribution margin ratio in order to figure out how changes in contribution margin impact income as a result of changes in sales volume. So in other words, we're going to use our knowledge of CM to easily predict what happens to the company's profitability. So first, what is the CM ratio? The CM ratio is CM over sales. So our contribution margin is 100 and our sales are 250,000. So if I take 100 divided by 250,000, I get 40%. The same is going to be true here. The book is calculating it using the CM ratio at break even. So at break even, the CM was 80, the same as our fixed costs, and sales were 200. Either way, you're going to get that same 40%. So what does that 40% mean? It means for each $1 increase in sales, contribution margin goes up 40 cents. So as an example, if we were at 200,000 in sales, if we go up to 250, we could take that 50,000 increase in sales times 40%. That tells us that our CM goes up by 20,000. And look, 80,000 was the CM at break even, and when we sold 500 bikes or increased sales by 50,000, the CM went from 80 to 100, up by 20, and profit went from break even of 0 up by 20 to 20. So whatever happens to CM happens to our income. And the CM ratio can help us arrive at that impact quicker. We can also get our CM ratio by using per unit numbers. So we know that the contribution margin per unit, if we have 100,000 as our CM and we sold 500 bikes, that's going to get us a contribution margin per unit of 200. The selling price, remember, was 500. So if we take our 200 CM per unit divided by our 500 selling price per unit, we arrive at that same 40% contribution margin ratio. The variable expense ratio is similar to the contribution margin ratio, except we take variable expenses divided by sales. So we can do that in total or on a per unit basis. The variable expenses are 150 when they're selling 500 bikes, and sales are 250, which gives me 60%. The numbers down here are using the Racing Bikes break-even numbers. So when they're at break-even, their variable costs are 120 and the sales are only 200, but notice you get the same 60% ratio. Also, remember our sales minus variable cost equals CM. Sales is always 100% of sales. The variable cost is 60%. So lo and behold, there's that 40% CM ratio that we calculated earlier. So all you need is one of the two. I could give you the variable cost percentage and you can get the CM percentage, or I could give you the CM percentage and you can get the variable cost percentage, because those two items, variable cost and CM percentages, always have to add up to 100%. And that's what the textbook's trying to prove to you here using algebra, which probably makes it more complicated than it needs to be. But effectively, when you have sales minus variable cost over sales, which is the breakdown of what CM is, sales over sales gives you 1, because it's the same thing over the same thing. Variable cost over sales is what the variable expense ratio is. So basically, this is just proving to you what I already told you, that combined, they have to equal 100%, so we can take 1 minus the variable expense ratio to arrive at our CM ratio. So if I give you the CM ratio is 60%, you know if I give you the variable expense ratio is 60%, you know the CM ratio is 40, and vice versa. So if I told you right now that the CM ratio is 30%, then you know the variable expense ratio is, and hopefully you said 70%. Likewise, I could tell you the variable expense ratio is 70%, and you should then be able to figure out the CM ratio would be 30. Combined, the variable expense and CM ratios have to equal 100, or 1. So how can we apply this knowledge? Well, I already did this earlier because I get excited and can't wait. So we're showing you that if our sales went up by 50,000, we could take that 50,000. So here's the 50,000 increase in our sales. You take that 50,000 times the CM ratio, and it'll tell you the increase in CM. And then again, whatever happens to CM happens to profit. So if CM goes up by the 20, then your profit goes up by the 20 as well. Let's look at a little example here. And again, you should be using the student version of the PowerPoint so you don't have the answers, so you can try it out. This is Coffee Klatch. We'll be using them throughout the chapter as little examples. See if you can apply what we just learned. So Coffee Klatch is an espresso stand in a downtown office building. The average selling price of a cup of coffee is $1.49. Variable cost is 36 cents. Average fixed cost per month is $1,300. An average of 2,100 cups are sold each month. What's the CM ratio? So pause the video and then come back and see if you have the right answer. All right, welcome back. Hope you paused the video. How would we do this? Well, if I want the CM ratio, CM percentage, as I like to abbreviate it, equals our CM over our sales. We can do that on a per unit basis. So that would be the CM per unit divided by the selling price. The reason I bring that up is the info here is on a per unit basis. So to get my CM per unit, it's going to be the selling price of $1.49 minus the variable cost of 36 cents. And then we're going to divide that by the selling price of $1.49. And that'll get us our CM ratio. So $1.49 minus 36 cents is $1.13 divided by 149 gives me 0.758, or B. What does it mean? It means for every additional cup of coffee this company sells, they're going to generate about 76 cents in contribution margin, which in turn means they're going to generate 76 cents in additional profit. And there's the calculation all prettified if you didn't like the way I did it. So now what we're going to do is apply this concept that we just learned to various changes. So the relationship between profit and the CM ratio can be expressed using the formula profit equals the CM ratio times sales minus fixed costs. So what that means is if we know a given sales level, we can figure out what profit is. All we have to do is take the sales times the CM ratio. That's going to give us total CM. And then if we take total CM minus fixed costs, that's how you get profit. So again, going back to our bike example, when we sold 250,000, if we multiply that by 40%, that gets us our CM of 100. Then take out our fixed costs, gives us our profit of 20. That's just a quicker way of getting to the bottom line profitability. If we know what sales is, we can always predict what profit would be. So if we want to say, what would profit be if sales was 300,000? We could take 40% times 300,000 minus the 80 fixed cost, and that would give us what, 120,000 minus 80,000, which with my limited math skills I think is $40,000. And we can do that at any level of sales. Nice, quick, and easy way to determine what our profits are going to be. Next concept we're going to discuss is how changes in variable fixed selling price, fixed cost selling price, and sales volume would impact our overall profitability. So our first example is what happens if we change unit sales from 500 to 540 by increasing the monthly advertising budget by 10. Well, one way we can do it is recreate the entire income statement incorporating these changes. Another way is just to focus on what is changing. So if we're increasing our unit sales by 40, I could figure out my increase in CM by taking the 40 new units and multiplying it by the CM per unit, which is 200. That means my increase in CM is going to be 8,000. And then I have an increase in fixed costs, which is the additional advertising, of 10. So the change in NOI is going to be an increase in CM minus the increase in fixed cost, so a negative $2,000. To prove that, we can recreate everything. So we could see that our sales, if we sell 540 units, go up to 270. You would take 540 times the 500 selling price. And then what students sometimes forget, which is why I like the method I use better by looking only at what changes, is they forget to change variable costs. If sales change, variable costs change. So you got to take 540 times the variable cost per unit, which is 300, to get this 162. If you don't like the way I previously did it and you don't want to go through all of this, probably the easiest thing to do would be fast forward right to contribution margin for a problem like this. 540 times my 200 in contribution margin will give me my total contribution margin of 108. And then our fixed costs went up by 10, so 80 plus 10 is 90, and then you can get your 18. But lo and behold, profits went down by -2, or they went down by 2,000, which is what I calculated right here by focusing only on what was changing. Now you might say, hey, Berube said whatever happened to CM happens to profit. What gives here? CM went up 8. Why did profit go down 2? Well, that's because something else also changed. Fixed costs changed. They usually don't, but on our assumption here they did. So yeah, CM went up 8, so profit should go up 8, but fixed costs went up 10. So that's why we end up with a decrease overall of 2. Plus 8 minus 10 is -2. Here is the shortcut method that I showed you typed up. Looks nice and pretty. And it arrives at the same conclusion that this would be a dumbass move. By increasing advertising 10 grand, we're going to end up losing $2,000 because we're only increasing our CM by 8 grand. So in order for this to make sense, this advertising campaign would at least have to increase our CM by 10 grand. So we'd have to go up by 50 units, I think, because 10,000 is how much my CM would have to go up. Divided by the 200 CM per unit means we'd have to go up by at least 50 units to make the advertising campaign feasible. Let's go through another example. What is the profit impact if RBC can use higher quality raw materials, thus increasing variable cost per unit by 10 to generate an increase in sales from 500 to 580? Well, a lot's going on here. But I know that my CM originally was 200. If my variable costs go up 10, my new CM is going to be only 190. And then if I sell 580 units, then I know my new CM in total, so total new CM is going to be 110,200. And we know our old CM was 100, so that means that overall CM is going to go up by 10,200, which remember means profit would go up by 10,200. So that's like a shortcut method that I would use, focusing on just what's changing. And you can see that that's proven right here by doing out the entire income statement. So sales, we took 580 times the 500 selling price to get the 290. But for variable costs, the variable costs are now 310 instead of 300. So 580 times 310 gives me 179.8. You could shortcut that by figuring out your new CM like I did, which was 200 minus the additional 10 in variable cost, or 190 times the 580 that are sold. And there's that 110, 200 I came up with. If we take out our fixed costs, that gets us 30,200 for income. And lo and behold, the difference is that 10,200 that I previously calculated. Let's go through another fun example. Look at all this stuff going on. What is the profit impact if we cut the selling price 20, increase advertising by 15, and increase sales from 500 to 650 a unit? Well, if we cut the selling price 20, that's going to cut the CM. So CM is originally 200 per unit, minus the 20 decrease in selling price gives me a new CM of 180 per unit, times the 650 units gives me a new CM of 117,000. So you can see our CM went up by 17,000. To get that new CM, I had to increase fixed costs by 15. So we take out our increase in fixed costs, and that means when all is said and done, profits should go up by 2,000. So again, this is my total new CM. The 17 represents the increase in CM. The 15 represents the increase in fixed cost. Because CM went up by more than the fixed cost did, $2,000 more to be precise, profit should end up going up $2,000. Instead of the shortcut, we could redo the entire problem and figure out what our new sales would be with the lower selling price, figure out what our new variable costs would be, because we have to take 650 times 300. Students tend to skip that part. I would recommend at a minimum, if you don't like my total shortcut method, to do something similar. You know your CM was 200. If you eliminate 20 in selling price, your new CM is that 180 times 650 is where you get that 117. Then you can get your new fixed cost by adding the 15,000 in advertising to figure out what your new income would be. But again, it's the 2,000 I predicted it would go up by. It went from 20 to 22. Could there be another example? Why, yes, there can. So what happens if we pay a 15 sales commission for bikes sold instead of paying flat fees of $6,000 a month, and we increase unit sales from 500 to 575? Well, if we pay 15 in sales commissions, that means our variable costs go up. So our CM is currently 200 minus the increase in variable costs of 15 gives me a new CM of 185. And then we can times that by the 575 bikes that we're going to sell to get our total new CM. So 185 times 575 gives me 106,375 for my total new CM. In addition to that, we have a decrease in fixed costs of 6. So our CM was originally 100. Our new CM is 106,375. So I'm going to move this. So our increase in CM is 6,375. Our decrease in fixed cost would be 6. So that means our increase in NOI would be $12,375. So again, I'm focusing on just what's changing as a result of these variables. Don't believe me? Well, here's the long way to do it. Recalculate everything. First thing we need to do is figure out our new sales. 575 times the 500 selling price is where the 287.5 comes from. Then to get our new variable cost, it's 575 times 315. The additional 15 in commissions are included in that. And then that gives us our new contribution margin, which is the same 106,375 I calculated. And then our fixed costs went down by 6 to 74, giving me a new profit of 32,375. The difference, 12,375, which is what I told you it would be. So focusing on what happens to our CM versus what happens to our fixed costs is all we need to do to figure out what happens to profit. Next item up for bids is a change in selling price. RBC has the opportunity to sell 150 bikes to a wholesaler without disturbing sales to other customers. What price would it quote if it wanted to increase profits by $3,000? Well, if it wants to increase profits by $3,000 for selling 150 bikes, then it needs to at least get $200 in profit per bike. No, I did the math wrong on that. It seemed too high. $20 per bike. Let's try that. So 3,000 divided by the 150 bikes gives me 20 per bike. So in order to make that happen, we know our variable costs for each bike equals 300, and then we need to make profit of 20. So the selling price has to be 320. We totally ignore fixed costs because remember, fixed costs won't change. So as long as we increase our selling price or get a selling price of 320, which is the variable cost, as I look at this, I didn't set that up very nice. Variable cost plus the profit we need per unit equals the selling price per unit. So as long as we get 320, we'll achieve our goal. So again, here it is typed up for you. 3,000 divided by 150 means we need 20 a bike. We also need to cover our variable costs. Fixed costs don't matter because they don't change in this example. So 150 times 320 gives us an extra 48,000 in revenue minus the variable cost, which isn't written out, but it would be the 150 times 300, which is 45, and that means our operating income goes up 3. Now you might say, wait a minute, this is sales, this is variable costs, that means this is CM. And you would be right. But remember, whatever happens to CM happens to profit. So if CM goes up 3, profit goes up 3 because in this problem, nothing was mentioned about fixed cost changing.